Hey guys, welcome back to Jack of All Trades podcast. I'm here as always with David. Today we're going to go over just a little bit of basic trading stuff again. David, I think, wants to show some indicators that he uses for his trades on TradingView as well. I know we covered that a little bit last week. So do you want to kick that off first, David?
Yeah, so I thought it's going to be a good idea if we started doing these short little segments every episode on how to do technical analysis and how to use some of the tools. So today I just wanted to show one of my favorite tools, or two of my favorite tools, which is the Fibonacci retracement and the Fibonacci extension tool. So this is XPeng. So there's a reason I chose this stock. It's because I know it really well. And right now what I'm doing is I'm actually using the replay function on TradingView. So this is actually in November 2020. And I just wanted to show how you can kind of use these tools because it's not fair to look at a chart going backwards and you already know what happened. But if you're going forward and you don't know what's going to be there, I thought it'd be cooler to show it like that. So this is XPeng's price action. So let's say we're in November 11th, 2020, and you kind of want to get an idea where the price is going to go. Because when a stock goes to an all-time high, you have no previous price action to kind of reference where it might stop at. You don't know where the resistances are. So one of the coolest tools to use is the Fib extension tool. And what you do is you find the swing low, the previous swing low, the next swing high, the absolute next swing high, and bring it down to the low again, right there. So you need to connect these 3 points, and it comes up with this tool. So, and I want to show you how to modify it too, because this is the way it comes out in stock is really ugly. So I hate having the background there. I like having the chart kind of clean like this. So these are the levels, and you can set these levels yourself too. So these are the 618, 7618. So these are all the levels that I've set. And usually you want the 618. That's a very important fib number. So 1618, 3618, and whatnot. And then, so you see, if I was trading this thing like a month ago and I did the fib extension, this thing almost hit exactly at the 3618 level, right? And if you go forward in time, let's see if this works. Play. There you go. And you see this price action going forward. Let me just extend this a little bit more. And you try to get an idea where the stock might go, right? It's kind of following these patterns quite closely. Let me keep going forward. And then it had the nice little jump there. It's still going, it's still going, it's still going, it's still going, it's still going. And I'll pause there, right? So if you're playing by these levels, look, it tapped out at the 9 and the 9618 level around there too. So these are like really cool levels to kind of like figure out. Like the 4618, I have it in a different color because that's one of the really important numbers. And look, it kind of tapped out there. So this is a really good way to kind of like figure out where prices are going to go when there's no previous price action. And then now what's going to happen is you're looking at it, you're going to go, well, it looks like it's hit a top and I want to know where to buy in at. So what I do was I'll use the fib retrace. And like before, you want to take the swing low and you go to the swing high. Yeah, see, this is what it looks like. It's really ugly. Let me just adjust that. So ugly. I'm not going to change the colors, but I'll get rid of the background. But look at this. So I took the swing low to the swing high, and it bounced right off the 50. Right, and so that's a really good way to gauge where the positions are good to buy in. I actually started buying in at the 50, but watch what happens. Where the 618 level is always the most important, and so watch what happens. And this is now we're into December, and that's it. That's what I was waiting for. It just pierced the 618 level. Actually, you know what? That's because I didn't go to the swing low. There you go. So that was my buy-in. I remember I even posted this on Instagram. Like I bought it at $39, and it went all the way back up. And so like this is a good way to identify like buying. I'm sorry.
I said I think that was the day that I beat you by like 10 cents on my order.
Is that right?
I got it like 10 cents lower than you.
Oh yeah, I remember that.
You were in at 39. I got in at like 38.8 or something.
Yeah, you were like almost bang on it. I was a little conservative. It was like 38 something. I'm like, I'm gonna front run this thing. I like being a little conservative, so I went like 39. But
You
well
know what's
played.
funny, actually, like a different way to use those, and because I remember, like you were the one that introduced me to Fibonacci lines because I never used them before. I had no idea how to use them, so I just started playing around with them on like my day trades. And that, if you look at like on your chart there, that daily,
You
like
did it. You did this way, right?
no,
Or is it the other?
yeah, because like I like to short, right? So
Yeah.
if you see, let me just get the dates here. So like in like mid November, like on the daily to the beginning of November, you had the first little pullback after the spike, right?
This one?
Yeah. And then that second one there. So if you take your Fibonacci and you go from the top on the second, like on the second consolidation, a little bit higher. So pull your Fibonacci from the very top of that one down to the bottom of that big red candle. And then
This one?
you should get the no, in the same, like in the same consolidation, just right up a little bit. Yeah, right there. Now look at the 2618 line.
Yeah.
So what I was doing, I just noticed that. So I was playing like those kind of moves in the morning actually worked out really, really well for me. So if you get a stock that spikes up first thing in the morning, I would always wait for, sometimes it doesn't reach that high, but I'd get like, on the 1 minute candles, I'd get, maybe one or two little red bars. It'd spike up a little bit more. I'd get one more little consolidation. And then on that second consolidation, that's what I'd do is I'd pull the Fibonacci from the top of that down to the bottom. And then I'd short it right at the 2618, and then I'd cover it down into the 1618, usually 2/3, and then I'd cover the last third down back into the 100 line. And it worked like probably eight out of 10 times that would work perfectly. It was really cool.
Yeah. Actually, I know a lot of people that don't use the fib extension and they use the fib retrace because it's a little bit easier because you need 2 points versus the 3.
Yeah.
Yeah. So, but it's very good. It's like almost the same idea. And like the 6-1, there's something about the 618 number. It's just super accurate. It's
I like
bang
that
on.
too, towards like the end of the day. Like if you get like a really good, like again on the small cap stuff, like if you get a stock that's kind of breaking out, like if as soon as you get like, you get a consolidation all day when the stock starts to break out towards the end of the day, you get that breakout and then that first big pullback before it pushes again higher. If you do the same thing you did there and you take the Fibonacci on that first big pullback, that's usually going to be the top of that run, like into the end of the day. So I'd short that up as well. I'd short that at the top of the day and then cover it down to the close.
Oh, interesting.
Yeah.
Yeah. So,
I was
yeah.
just
So,
playing around with them after you showed me them for a while, and I thought it was pretty cool. Like they're really accurate.
yeah. And so that's what I like about this thing. Like you could, like you probably spent hours too. Like you just take the fib and you just go back test this thing and like any chart, anything that you're trying to watch and you just see how accurate it is. And then you kind of figure out how to determine the highs and lows. Cause it does take a little bit of playing around.
Mm-hmm.
But like, so I remember I got in at like the 39 level, and then what I did was you could use the fib retrace backwards too. So you go to the swing high and the swing low. Oops, did I do that right? Hang on. Oh, hang on. Oh, I got rid of my numbers. Hang on, let me just do this. No, I can't do. Oh, it's not on log. That's why. Okay. Let me just change this thing around a little bit. Oh, I got rid of my numbers. Sorry. So I while we were talking, I got rid of these numbers, and that's what I wanted. Actually, those aren't important. The 618 is the most important. I'll put the 65 there too. So so you could pull from the swing high to the swing low, and then it actually works backwards too. I'll play forward, and then I ended up selling. I think somewhere around the 618. Right.
Okay.
I ended up selling right there the 0.5, and that's before where it pulled back. So that's like a good way to find out like where it's going to top. Yeah. So I did end up selling the 618. I remember that. So it pulls back to the 618, and it just took a dump after that.
Right.
And so like what I noticed like on the larger time frames, like we talked about this all the time, like market forces and news kind of change the direction of the technicals. But if there's no news and it's just regular trading, like these things follow the fibs really, really well.
Yes.
And I can imagine for the time frames that you play, like it's since it's less what is it, less at the mercy of news and whatnot, it's probably like super accurate.
Yeah. It was really close because I mean, unless odds of getting a news article in the middle of the day or something is, it happens, but it's pretty rare. So you don't really have to worry about that kind of stuff too much.
Yeah, and I want to just show one other thing that I think worked out really well. So the fib extension works backwards too. Swing top, high, low, high, and it gives you an extension there. And I'll pull up these numbers because, like, so what is it? XPeng started crashing like like around with the rest of the market,
Right.
and it's a good and this was the first swing low, and so you wanted to know if it's going to swing low again, where would it stop? And I think this number was where it stopped at. It was pretty accurate. There you go. Oh no, it went forward. It went even more. Oh yeah, maybe it was the 6-8. It was like almost at the end of where is this thing? Did I close open all these? Oh, you know what it is? I had another chart where I think I had like 8618. It was like a custom number because you could play around to see what works. I think that was the one where it hit. Oh, almost. Did I do that wrong, man? Oh, fib. Because I'm on log skill. Sorry, that's what happened. So if I make it not log, I think it'll be more accurate.
Because that's what like Fibonacci is usually what you use for almost all your trades, right?
Yeah, it's what I use for to whenever I'm, especially with like because I used it a lot with Bitcoin, because it's like if you don't have like previous price action to figure out where things are going to be, then it's like, what do you do? Like all you have to rely on is fibs, right? And the thing is, like now because now that this thing has previous price action, like, you know, we would just draw a resistance line. You could see like it bounced right off the resistance, which was previous support, and it's like so it's starting to play really technical now. But before, when there's no previous price action, it's like, what do you have to go on?
Yeah, and like a lot of the time in like day trades and stuff like that, I mean, you have, you know, you look back a couple of years or whatever, you can look at the daily chart, so you can almost use that as a secondary indicator. Like if it's, you look back to 2018, for example, a couple of years ago, and you have a stock that's spiking up to new highs over even the past, you know, 2 years, then you can use that. That's what I was doing, is drawing those lines in for my shorts, and then I'd look way back, and you know, if the Fibonacci like was hitting, I don't know, say the stock like it's, you know, it's hitting 7.15, for example, like $7.15, and look way back and I see there's big daily resistance at like 720, then I'm like, okay, like that's perfect. I got two things lining up now.
Yeah, it's super cool. Yeah, I don't know why it's not lining up. I wish I was, because this is the account that I made that doesn't have my own indicators. But I could swear I wish I could swear the one where I had my own indicators, it was bang on. I used the extension tool and it was bang on, bounced right off this, but I don't know, maybe I'll post around it later. But anyway, that's how these tools are used, and you can customize them, and they're pretty cool too.
Yeah. Yeah, you can use it way. Like, I mean, I think that's the biggest thing for anybody is just you know, like we said, you're just drawn basically from tops to bottoms of full size ranges, and then just play around with them on whatever kind of trade you're looking for. If you're looking for a short or a long or a dip buy or whatever, and just back test. Like, you know, David said, I took hours. I'd say I definitely took days back testing it before I started using it. So
yeah, and it's just fun. Like this is still the free version too, so you can just like go on here and play. Like, but look how technical this thing's trading, right?
yeah, that's what I like to see.
Yeah. All right, so that's it for me. Earnings. Earnings surprise to the downside. That's what happened. But yeah, that's it for the trading view thing. And then the other thing I wanted to touch on was like, unless you want to go do anything first.
No, it's all you, man.
Yeah. So like if you like, I posted on Facebook, I bought a Tesla, obviously, or put a down payment on a Tesla. But then one of the biggest things I had to think about was like, do I want to exit some of my investments and pay it off in full? Because it was like before tax, it was like 71,000, something like that. And so it's like, do I want to take a lot of my money out of the market and pay it off in full, or put like a decent down payment and then get it financed, right? And we're in a low interest environment too, so that's why I kind of pulled the trigger on it now, because I wanted to lock in the interest rate. So I saw for Tesla it was 3% interest if you want to do like up to 90 months, and it was 2.49% interest up to 72 months. So it's a little bit cheaper if you want to do like a shorter term. And then when I went into the dealership, the guy says, well, Scotia's running a promotion right now. It's not on the books, but if you just apply, you're going to get 2%. I'm like, holy shit, you're just giving that away then, right? So I put the calculator in. So I ended up putting like a 2,500 deposit with 15,000 down payment. So like 17,500 down payment. And so basically Scotia, this is the amount Scotia loaned me, 63,300 and change at 2% interest over 72 weeks. And so what I found was like, basically to borrow $63,000 will only cost me just under $4,000.
Right.
And that's over the 6 years, right? So I'm like, so the calculation is really simple. It's like, if I have the $63,000 free to invest in, am I going to do better than $4,000 return in 6 years?
I sure as hell hope so.
Right? It's like, if I can't do that, I should just quit, like just stop.
Yeah.
Like even if I just bought the S&P, bought an index fund, I should be getting like 6-7%, right?
Yeah. I was just gonna say, I just 63,000 times 8%, which is the S&P. That's $5,000. If
5,000. So
you put that 63,000 in the S&P for a year, take it out, you've already earned over $1,000 on what you're paying on interest.
yeah, just absolute no-brainer trade. No stock picking, no work at all. I'm still making up better than, if I paid it off in full.
Yeah. It's a really fun. I can't remember if we mentioned this on one of the other podcasts or if I was just telling you about it, but it was when I read that article like a month or so or a few weeks back about this the exact same thing, only with mortgages, right? Like on, like I just saw it was on Bloomberg or something, and it was like the title was why you shouldn't pay your mortgage off now and keep investing your money. And I looked at it and I was like, because it's something I never really thought about, right? Your whole life, everyone's like, oh, you get a mortgage, just every spare nickel you have, you just pay it off, like just keep paying into it. I was like, okay, this is interesting. Let's give this a read. So I was reading into it, and the whole theory behind it was exactly what you just said. It was like, okay, if you're, let's say, I don't know, for argument's sake, you have $2,000 a month extra that's just, savings. So, okay, maybe you're going to put $1,000 or $1,500 of that into the mortgage every month as like extra payments. So you could either do that, or you could save that money for the year, and then you have $15,000 or $12,000 or whatever every year extra that you can invest in the markets and make even more money on, right? So it's the exact same theory. It's like, why would you pay it off in little pieces when you could say, if you have a 30-year mortgage, instead of chipping away at it, you just save all that money for, 10, 12, 15 years, even whatever it is, invest all that money, earn all that interest, and then you can pay it off all in one big lump sum. And then overall, you've actually earned quite a bit more money than if you had to just paid it off in little pieces, like a lot more money. Like we're saying right here, even on your Tesla, in 1 year on the S&P, which is, that's like everybody's safe bet, basically. You would earn on that lump sum of money, you'd be pretty guaranteed to earn $1,000 more than what you'd be paying over 6 years in interest in 1 year. So if you do that for the whole 6 years, you're going to be up basically $30,000 that you wouldn't have if you had bought the car outright, which is really weird because nobody ever tells you that stuff, right? But it's if you look at the math, it's a no-brainer.
Yeah, exactly. It's like, if you just put it in the no-brainer index, not only does that return cover the interest that I'm paying Scotia, but I'm making out a little bit extra on top. It's like until you visualize it a little bit, it's hard to think about. But once you do, you're like, this is so obvious. The play is so obvious.
Yeah, like it's almost just like one of those things, it's kind of a pain to like, see you have payments every month for something like coming out of your account. But on the flip side, financially, it makes perfect sense. It's the weirdest thing. But I mean, like it's the way a lot of businesses run too, right? Like you look at Donald Trump, like he's a professional at taking loans. That's all he does. Like the guy's in debt and he's still worth millions of dollars, right? Because he's just a professional at taking lones. But even business, any kind of business, I mean, every business starts out with big loans, right? Like let's say you had this vision, you want to make your own company. Then, what do? I need $100,000 to start this company. So I'm going to work for the next 20 years, whatever it is, try and save up $100,000. I'm just at my regular day job. It takes me, say, 20 years to save $100,000 that I can afford to put down towards this business. Okay, now I'm, 40 years old. Put all this money down towards the business. Now I'm starting from square one at 40 years old. Or you could take a loan, start the business now when you're 20, and then work your ass off, get the business up and running, pay off that loan in, say 5 or 6 years if you're running a pretty successful business. And now at 25, 26 years old, you're where you would have been when you were 40, right?
Yeah, I think that's a really good point. Like, it's hard to look at time as an asset, but time is an asset too. And if you as an asset that has monetary value in terms of income generation, then you can kind of look at things in like almost a 3D perspective versus kind of flat 2-dimensional, like, and like, And I think it like, especially like that's kind of like where I learned it from, like businesses. Like I'll give you a perfect example. It's like Tesla. Financial engineering is like one of the keys to like Apple's success and Tesla's success, right? So Tesla does something very interesting with their suppliers. I think they're on a 45 or 60-day billing cycle with their suppliers, right? So they'll order whatever and they'll pay them like 45 and 60 days later, right? But because their vehicles are made to order and they deliver every vehicle and don't hold any inventory, they get that money back within 30 days. So they almost get like an extra 15 days of extra cash flow there,
Okay.
per car sold. So they have extra cushion, right? So like, some of the best companies in the world, especially like Apple, like they know how to mess with the finances in the background. And that's the key to success. It's not just so much like, oh, you have a really great product, you have a great marketing and it sells a lot. It's like, no, if you handle the back end, you can have a pretty shitty product and pretty mediocre marketing, but you can still be quite profitable.
Yeah. It's just basically about money management, right? Like,
yeah,
it's the thing that literally separates, the wealthy from the not so wealthy. It can make a huge difference in everyone's life, no matter, what your income is. And it's the one thing that they don't teach you in school.
no, and I just learned something else more recently too, like, because we talk about owning assets, right? And like, I didn't realize it until recently. Like, it's something you kind of know in the back of our head, but until somebody says it, you don't recognize it. It's like there's productive assets and there's non-productive assets. So like a productive asset, it's like a home. You own it, it can accrue value, it has value, but then you can also use it for something. You live in it, right? So like a car is kind of a productive asset too. But then there's non-productive assets, which is like gold. So what does that do? Nothing.
Right.
Right. You buy it today, you might sell it for more later, but in the meantime, it does nothing. Right. So then sometimes, like when you're looking at investments, you should look at the asset. You should split those into two categories too, and say maybe I shouldn't be all in on these non-productive assets. Even stocks are non-productive, right? So you kind of split the portfolio a little bit. Like, let me buy something that's productive, and let me buy something that's not non-productive, and kind of hedge a little bit, but not go all in either or.
Right.
Right.
Well,
because like
dividends.
Yeah, because we're not.
Right.
Yeah, because we're not rich, so it's like we have a limited pool of money to play with, and so like we have to be very wise in how we kind of like spread it around a little bit.
Right. Yeah. It's like, I mean, like for you or I, like we have like pretty much almost all of our money is in the markets to some degree, right? So, if I have like, let's say I have all my money in the markets and it's a bad year, and then my furnace explodes and I got to spend 10 grand to fix my furnace. It's like, shit, I got to sell this stock for a $20,000 loss. So there's gonna be a $30,000 furnace I got to install because I got to take that money out, right?
Yeah.
So it's like, you gotta kind of play this dance around having money that you can use, but also being able to turn it into more money effectively. And that's really what diversification is, right? Like, I mean, everybody does it in different ways. You could have, like you said, you have your house, you have some dividend stocks, you have some growth stocks. Like for me, I day trade, so I'm like, one of my accounts is always liquid money. Like I never hold anything overnight. And then I have my investment one, which is always pretty much just, in the markets. It's just always in stocks, right? So if anything did happen, absolute worst case scenario, I always have my day trading account to take it out of. And then the next step is real estate, which becomes even less liquid. But you always want to have varying levels, right? Like, I mean, like real estate is very difficult to get rid of in a hurt. Not very difficult, but it's tougher to turn that into cash immediately. Yeah. The next step would be a long-term investment. You can turn it into cash immediately, but are you up or are you down on the stock, right? And then the next step would be kind of like day trading as far as investments go. Is it's something, or short-term swing trading, something that you're constantly turning over and making more money that's usable.
Yeah, it's a really good point. There's like how I guess it goes back to the question of time too. Like how liquid is an asset, right? Like you're saying, like houses, like you could sell a house quickly, but the faster you sell it, the probably less value you're gonna get out of it, right? Probably have to sell it for less, and then you have to stage it. Like you maybe pay less for staging or pay more for an agent. Like you start to lose, right? So like, I think we might have covered this on the first episode, but I think like there's always been this debate, like because guys like Mark Cuban are always like diversifications for idiots. Like even Warren Buffett has said sometimes like diversifications for idiots. But I think they don't realize that most people are interpreting what they're saying incorrectly. Like, because what they're saying is diversifying. Like this is the wrong diversification. Having a portfolio of stocks Like I'll own a car company, and I'll own maybe Apple, and I'll own maybe, I don't know, Netflix or something. People think that's diversification because these are like 3 different stocks in 3 different industries. Like, no, they're all still stocks. If the stock market crashed, you're still fucked.
Right.
Right. So it's like when Warren Buffett says diversification is for idiots, he's saying that kind of diversification is for idiots, right? These guys are thinking at a high level. They're like, diversification means I'll have a portfolio, entire asset portfolio of property, stocks, bonds, gold, like a whole bunch of different asset classes, right? So if the
Right.
stock market crashes, my home might hold value or might gain value. And so like these are almost uncorrelated.
Right. It's funny when you first said that, the first thing that popped into my mind when you said like, someone like Warren Buffett says diversification's for idiots. I was thinking you were going to say that he means like do what you know kind of thing, right? Like don't try and don't try and short something if you're a long bias trader or whatever. But that makes sense.
Yeah. So like I think people misinterpret what they're saying. Like diversification is for idiots. Like yes and no. It just depends on what you mean, right?
Yeah.
And like yeah.
You never
so
really get trapped like that, right?
No. And that's why I bought the Tesla, because like I've sat through a few crashes and I'm like, I don't feel like sitting through another bear market unless I have some other kind of assets, because like it's a pretty helpless feeling when you're like when your stocks are down and there's nothing you could do about it. You don't want to sell it when it's down, right? So it's like I want to get some productive asset out of my investment. So I'll put some money. I'll take some profit and I'll put it into Tesla, or put it into the car. So I have a productive asset too.
Right. That makes sense.
And we're talking about how like they hold their value too, just in case if I ever need to sell it or whatever.
Yeah, I was actually, because I'm looking at buying one in the fall potentially, and I was doing some research into them, and they were like a lot of the articles I was reading, and like even just from doing research on used Teslas that are for sale, is they're saying that over the same period of time, like over like a 3 to 4 year period, based on the same driving and external factors, stuff like that, vehicles that are in the same class as whatever Tesla vehicle it is depreciate on average about 30 to 34%, whereas the Teslas depreciate only 10%. So if you buy, like let's say they're both $100,000 cars, over a period of 3 to 4 years, that Tesla might only go down, say, $10,000 or more if you're driving a lot of kilometers or whatever it's going to be. But over the same period of time, a car like a gas vehicle that's in the same class would go down, say, $30,000 or more. So over those 3 to 4 years, I guess you call it unrealized gains. It's still a loss because it's a vehicle, but call it unrealized loss, saving an extra $5,000 or $6,000 a year.
Yeah. Oh, you're frozen there a little bit.
All right, we are back. We just had some technical difficulties, so keep things rolling along. Can't really remember what we were talking about.
Yeah, but I did want to get your idea, because so I was driving the other day and I was just thinking about my portfolio, and you know how I'm kind of a pessimist, right? So I'm always thinking like maybe I should get out of the market, or how much should I get out of the market? How much should I go into cash and whatnot? So I thought of a strategy that's kind of like a swing trade or position trading, but kind of not. It's kind of, have you ever heard of this guy named Nassim Taleb?
Is that the guy that used to work for Facebook?
No, that's Chamath. So Nassim is like, he has a quant firm, and he made quite a bit of money during the '08 recession.
Okay.
So that's how his claim to fame was a book he wrote called Black Swan, and the whole theory about that is like, most people if you go through the world and you only ever see white swans, you think only white swans ever exist, right? So that's the conventional wisdom. There's only a white swan, even if there's millions and millions of white swans, but it only takes one black swan to show up to change the whole narrative, to make that what was once true completely false.
Yep.
Right. And so his whole trading strategy, his firm's trading strategy is kind of based on that. It's like they'll make thousands of small bets against that, basically counter trades the market, and then they'll basically lose a little bit of money consistently. But the one time they're right, they make like 100x. Right. So
it's really weird style.
Yeah, it's a really right. And so it's kind of like what I'm thinking. Not as crazy, but it's kind of what I'm thinking. Like I haven't decided yet, but I just wanted to get your thoughts on it. So like my strategy is, so right now I'm like, I'm like maybe 10% in cash, right? 90% I'm holding equities. And
Okay.
I'm worried that the next few years might be either choppy sideways or there's a chance it might go down, right? That's just my view. And so my thought is like, if we get any kind of like a little bit of a rally this summer, I'm gonna start selling my stuff, maybe even sometimes at a loss. I just want to be in cash for a bit till I can figure out what's gonna happen. And then so my next thought was like, well, if I'm sitting in all that cash, what do I do? Because we were talking about productive assets, and you want that cash to do something, right? And so I was thinking like, what if I had a strategy where it was kind of like Nassim's, where I'll just sit in cash for a while, and I will only ever buy like hard pullbacks, right? So I'll give you an example. So like over the last 10 years, Tesla has pulled back 6 or 7 times 35%, and at least 3 different times 50%.
Okay.
And so my idea is I'll have like a small group of stocks, maybe 5 or 6 that I'll watch consistently, and I'll kind of like track their pullback. So like, Apple will pull back on average maybe 5-6% if it pulls back hard. Tesla will do like 35 to 50. And so I'll sit in cash and I'll just wait for that one hard pullback. So like imagine if you caught Tesla pulling back 35%, if it just went back to original price, you just made 50% on your investment.
Right. Yeah.
And so that's what I'm wondering, like, because I'm like think about it this way. Like if I have a portfolio that grows at 15% a year for 10 years, I might do like 150% return on that portfolio, right? But if during those 10 years, I almost don't deploy that money at all, I just catch one of these, March 2020, 50% dips, I've doubled my money. Right? So I'm wondering, like, I haven't done the math yet, but I'm wondering if that should be part of my strategy now. Like just sit like 40% in stocks that I like and just continue doing what I'm doing, but have 60% cash, just have it sit there. Just kind of like take advantage of these pullbacks.
Yeah, it's a tricky question. I think it really depends on how much money you have at the time and how much you're like where you at in your life for any, not just for you, but for anybody. Like the idea of that makes a lot of sense. I mean, like when you first said that and I said I don't like the idea, I thought you meant that he was just like, every day he was just putting little bits of money in everything constantly to try and wait for something to go wild, which is kind of weird. And I don't think that's a very smart thing to do. But if he's just sitting in cash, I mean, like that's I think almost very common for a lot of the guys that are big traders. I mean, I hear that all the time. Guys will say, like, if I don't know what's going on or I don't see anything, there's nothing wrong. It's actually sometimes the best move is to do nothing, right? If there's nothing you like, you don't have to just put your money in something. Like if you know your A+ setups and you know what makes you money and you don't see one, then you're gambling, right? And if you're trying to make a living off of it, you don't ever want to gamble because then you're just risking everything, right? But I like the idea of that. I mean, like from my perspective, the guys that I'm kind of involved with, we always preach that the black swans are the things that you want to watch out for. Cause like I'm predominantly a short seller now, and it's the same story, only in reverse. I mean, I'm shorting small cap stocks. So like I'm trying to make 10, 20, 30, 40 cents on a move or whatever pretty consistently every day. But you can do that for a year. And if you get overconfident and you get one of those black swans, which do happen, like, you look at any of the Bitcoin stocks from 2017, like what are some other ones like LAKE, GME, like all that stuff, right? If you get one of those and you're doing the same thing you always do, let's say, like you short something at, $2.50 and then you keep adding and adding and adding, like it can go up to $50. Like it can cost you millions of dollars. It can wipe out a whole year's worth of profits if you're not. It could blow you up completely. It could end your career in one trade, right? Which is really, really something that you always got to be aware of. That's why, like for me personally, I mean, on the long side, it's not as big of a deal because most you lose is what you put in, right? But on the short side, you can blow everything and more. You can put yourself in debt, right? That's why I always preach risk management and stuff like that. But I mean, that's. If you look at anyone who's a really big investor, I mean, all of them pretty much that I've read about have said, 95% of their wealth is made from 1% of their trades or 2% of their trades, because that's what they're doing. They have this consistent system where they're like, okay, I know I can make, X amount of dollars on a weekly or a monthly basis or whatever, but they're always ready for that one that like you're talking about, where it's like, okay, like this is it, that we got a huge market crash, throw everything at it, and then maybe last year, the big guys, they made 20, $30 million, whatever. In this one trade, maybe over a few months, they're going to make $200 million, which is a decade of what they're usually making, right? Like, but I see it all the time in day trading too. Like, for example, like there's a handful of guys I follow, and like they've been doing this for decades, so they know what they're doing and everything. But like on GME and stuff like that, good example. One guy I follow, his consistent daily wins are, I would say in the neighborhood of like $2,000 to $5,000, maybe probably around like $3,000 on average is like what he makes every day. And he'll do that for 8, 9, 10 months every day. He'll make $2,000 or $3,000, $4,000. And then on GME, I saw him make $400,000 one day, right? So he's making, almost a whole year in half an hour when he sees that one black swan move, right? So I think the idea behind that is something that everybody does. It's just a matter of how much capital you can sit aside to prepare for that and how often that particular trade is going to happen. Because in small caps and stuff, like you'll see one of those kind of moves, maybe, I don't know, maybe a couple times a year, like probably more now because there's more retail traders, but I would say maybe a small handful of times a year. If you're lucky, you might get those big monster moves that you can capitalize on. But I don't know as much about, the big caps or the broader markets. Maybe that's something you have to wait for, like an actual like market pullback. So maybe it's like we had in 2008, that's when you get your move. And then maybe you don't get it again until 2025, right? Who knows? But by the same token, I mean, if you're going to make, if you're making 100 grand a year, for example, every year, and then 15 years go by and you're doing that, and then all of a sudden you get this big crash, maybe you can make $50 million in a few months, right? So I think the idea behind it makes a lot of sense. It's just, depending on what type of black swan you're looking for, when's it going to happen? And you got to be ready to spot it. And you got to be prepared mentally to throw the kind of size at it that you need to in order to make sitting that long in cash worthwhile, right? Because if you're only going to take a small position and you've been sitting in 60% cash for a decade, then it probably wasn't worth it. But if you've been sitting in 60% cash for a decade and it's like, okay, I'm throwing everything I got at this thing because I know that this is what I've been waiting for, then I would say it's worth it.
Yeah, that's actually the way I want to go about it. Instead of spreading it out, that's why I want to just watch like 5 stocks. And I'm waiting for a market pullback. I'm not waiting for the stock to kind of independently pull back because of bad earnings. I'm waiting for like a market thing that just the entire market sells off. So it's uncontrollable.
Right.
And then I just want to catch it, put like, 40% of my portfolio in that one like pullback and then see what happens. Because what made me realize because I was looking at my chart for my RSP, right? I've had that since 2012, so like 9 years. Like I'm beating the S&P. Like I did like a 300% return in like 5 years. Like I'm beating the S&P handedly. But that one COVID play, like I almost 4x my money because I was sitting in 65% in cash when the market tanked like 35%.
Right.
And Tesla went down like, I don't know, 70%, right? That one move just erased 5 years worth of work.
Yeah. Exactly. So you've done it, right? So you've already done it before. That's a good point too. Is if you are looking at just a couple of companies, I was watching an interview with Jeff Bezos the other day, and he was saying, he kind of made the point that the company is not the stock. Like the stock price isn't the company necessarily. He's like, I've sat there in the office of Amazon and I've seen that our sales are through the roof, our earnings are through the roof, our consumers are through the roof, our deliveries are through the roof, and the stock price has been steadily declining for 2 months. So he's like, everything I'm seeing on the company is going up and up and up, and the stock price is going down. He's like, the stock price is not the company. So that's not necessarily as correlated as people want to think it is. So if you do get a huge market pullback like that, that's a really good thing to remember, is that stock is not necessarily the company. So you're buying it at a discount.
Yeah, because I've spent like the last few weeks just looking at just charts, right? Especially the S&P. Like I've looked through like 150 years of the S&P, and I'm looking at all these pullbacks, and I'm like, when a market pulls back, I don't care how good of a company you are, you're going down, right? And I think Amazon went down like 50 or 60% during the dot-com. No, it went down 80% during the dot-com bust. And it went down like 50% during the financial crisis. And those happened within 7 years of each other. So imagine if you'd have bought Amazon and it went down 80%, even if you caught it at the 60% mark, went down 60%, if it just returned to previous high, you would have almost 3x your money.
Right.
And then like a quick 7 years later, the financial crisis happens, you do it again.
Yeah. And then last year, COVID happens, you do it again. Like,
yeah, within within just a 20-year period, you do 3 trades and you probably like 100 extra portfolio.
Yeah. That's the thing, right? I mean, like, like that's why I think all these guys, that's why they say that's where they make most of their money, right? But the reason we have to trade all the time is because we need money, like we need an income, right? So like, you know, I can't just be like, oh, I got X amount of dollars in the bank. I'm just gonna sit here and look around for a decade and wait for a trade to come. You can't do that, right? Like you need to pay your bills. So it's like you got to have that little consistent income. But I mean, that's probably the big game plan. I mean, like I wasn't ready for the last crash because, you know, I'd been day trading and I wasn't at a point where I had enough capital in the bank to really invest in anything like that. But like for the next one, you can definitely bet I'm going to be ready to throw some serious money at it and get a good pullback. Like,
yeah. No, that's a great point. Like I wouldn't have done this like 5 years ago, even, or definitely not before that, but even 5 years ago, I wouldn't have done this.
Yeah.
But like we've touched on it before, where like the more I look at my portfolio, the more I realize like I'm starting to get risk averse. I'm like, because like just right now, like if last year I did really well in my portfolio, and if the stock market pulls back even 20%, I've just lost a big chunk of my gains, right?
Right.
And so like for me, this now I'm like I want to change my strategy to where like it's less about maximizing returns and it's more about preserving capital.
Okay.
Right. Because I think it's like when you're, it's almost like a startup idea. It's like when you have a small portfolio, you're a startup, you're like scrappy, you have nothing to lose, you just want to go gung ho and just go all in.
Right.
But after you're kind of like established, you kind of want to preserve what you already have.
Right.
Because like a 50% market pullback, like let's say we have like another financial crisis, so 50%, it took 3.5, almost 4 years for the entire market to get back to where it previously was.
Right.
So so what am I going to do if I'm 100% in equities right now? We have one of those, and for the next 4 years, I'm just sitting there.
Yeah, you're stuck.
I'm stuck.
Yeah.
But if I had even 20% of my portfolio in cash, I'm
Right.
kind of giggling on the side, you know.
Well, that's where, you know, diversification of trading style, I think, is a big important role in that, right? I mean, if you're, let's say you have 30% in long-term investments, you have 30% that you short-term swing trade, you have 30% that you day trade, and then you're, you know, I don't know, I wasn't not doing math when I was saying all that, whatever's left, you're just sitting cash.
Yeah.
Right. Or, you know, you start like when you have extra money, you buy some real estate, right? Like whatever it's going to be, it's got to be spread out enough that you can actually capitalize on those things, which is difficult to do until you get to that point. So I think a lot of people need to work their way up to that, to the point where they can actually have enough cash to be able to throw into something like that. Right. So it takes time. It takes time to get there. Like I just said, I wasn't ready for the one, you know, a year ago or whatever, because I wasn't in a position where I had that kind of money to throw into it. So I sat there and watched it and I studied it and I learned, but I didn't make any money on it. So
yeah. And like even before the COVID crash, I was already kind of like, because the big reason I was sitting 65% in cash was for two things. One of the first investment books I ever read was Warren Buffett's, and it turns out that he made the bulk of his original fortune in the 1971 crash. Because the late 60s, he had a partnership. He was investing people's money. He had like $3 million in the partnership. And he was experiencing exactly what we're experiencing right now, where the market was just bipolar. It didn't make sense. And he's like, I don't understand what's happening, right? And so because he was a responsible guy, he's like, let me dissolve the partnership. I'll give everybody back his neighbors and his family's money. I'll give everybody back their profits. And because I just don't feel comfortable investing in this thing anymore.
Mm.
And so when the 1971 crash happened, I think that was like a 70% pullback, 65, 70% pullback. The guy was sitting at like $3 million.
Yeah.
And he was buying like good companies for like 10 cents on the dollar.
Right.
And like within 2 years, he was worth $100 million just because he was just, you know.
Yeah.
And then the other thing I realized after that was like just before the COVID crash, I'm looking at horrible financial crisis, and I'm looking at just the FANG stocks. These are like the no-brainer stocks, right? Netflix, Amazon, Facebook, whatever.
Mm.
If even coming out of it, even if you come out of it during like late 2009, if you'd have put any money in any of those 5 stocks, they would have returned you anywhere between 10 to 16% pre-COVID.
Right. Right.
And so it's sorry, 10 to 16x. Sorry.
Oh, okay.
Yeah, and so like I was sitting in cash because of those two things. Like I saw the COVID thing happen. I'm like, let me start. And Tesla happened to be kind of going up at that time, and I'm like, I need to start selling. And like,
Right.
and I started selling really early too. Like I started selling at $385, which was the previous high, and Tesla topped out at 1,000, but I was already selling at 385.
Right.
Right. And to like, even at certain points, I was like, fuck, am I being stupid? Am I selling a little bit too early? But then once that thing crashed, I was like, holy cow, what a game changer, right?
Yeah. Well, that's the tricky thing too, right? Is a lot of people don't realize, like, you look at Tesla, for example, like it's a good solid company. Like it's not a junk stock by any means, but the thing is when companies start moving like that, they become just a technical play, right? They're not, like, at this point, it's not an investment. And then people start throwing their money and they don't know what they're doing. Like, good examples like Moderna that I can think of as well off the top of my head. If you look at Moderna on the daily chart, like back when they announced their vaccine release from, whenever it was, 6 months ago or whatever that was, it had this big spike from $100 to 170 or whatever. And I remember a bunch of people were like, they're telling me like, oh my God, I should have bought that, blah, blah, blah. I'm just like, you watch that thing. I was like, it moves that fast. I was like, I guarantee you that thing's coming straight back down. And it sure enough, it did. It went from like 170 down to like 120 in a matter of like a couple hours or something like that, just tanked hard. And it was, if you look at it technically, it's like, if it wasn't $170 a share, that'd be the perfect kind of play that I would like to short, right? So there's a point where, you got to kind of combine the two, like have really good technicals and a good understanding of those kind of moves as well, which is, a lot of investors don't. I don't want to say a lot of investors don't, but it's something that not a lot of people are as aware of. If they're investing in good companies, they think, oh, it's moving really fast. We'll buy some more, and then it'll come right back down. Like I know a bunch of people who bought Tesla at the top, and now they're way underwater because they're like, wow, it went X percentage in a couple of months. Like it's flying. Let's get in now while it's still flying. And it's like, that's not when you want to buy. That's when you want to sell, right? So that's something a lot of people need to remember too, is it's when everybody's excited about something, that's not the point you want to buy. That's when you want to start taking profits.
Yeah, it's a weird psychological thing. It's like so tempting to jump in when everybody's buying and its stock's going up, but like you should be thinking counter trend at that point. It's like, no, you should be selling.
Right. Yeah.
Well,
it's just, it's buyers versus sellers, right? If you look at a stock and it's flying up, it's like, okay, what's happening right now? Like people buy a stock because they think, okay, it's a good price. I want to buy this stock at this price. This is good. Stock, let's say it's $100 stock, goes up to $120. People are like, oh, it's flying, it does that one day. People are like, oh, it's ripping up. Let's buy some more. Goes up to 150. More people, oh, buy it. It's going up. Let's say that thing gets to $250. Eventually, even the people that were excited and chasing are going to be like, I don't want to buy this thing for $250. That seems a little expensive now. All those people are going to disappear. And then all the short sellers are going to come in and say, okay, this thing's starting to look a little exhausted. The volume's kind of coming down. They're going to pile in and start selling. And then everybody who was long in the low, around $100, they're going to say, okay, like I just made, 100% of my position. I'm going to take some profits. They're going to sell. The short sellers are going to come in too, and it's going to come straight back down. So it's just a matter of thinking of like, when you see any kind of drastic move like that, it's like, okay, who's taking this move? Like what's happening right now? Like who's executing orders? Is it shorts? Is it longs? Are people covering? Like what's happening here? You got to look at both sides of it and figure out, who's in control of the stock.
Yeah, I think I see. So I started going on Twitter a little bit more to read the comments, and I'm like, subscribe to some hashtags like Tesla, whatever. And like when Tesla stock started going down, like last few weeks, like people are like, who are selling? Like who would sell Tesla? I'm like, oh my God. Who would sell Tesla? The guy that bought it at $300 a share. They're happy to sell it now at like 600.
Yeah, right. Exactly. Or the people that are thinking, okay, this thing ripped up like crazy. Let's short it and make $100 to the downside or whatever, right?
Yeah, they don't realize it's a cycle. Like things just don't go up in a straight line and stay up.
Yeah, it doesn't work like that, and that's the problem. A lot of people don't realize. Like I flip through Twitter every now and again just to look at like the junky stocks that I follow, and it's like like AMC is a good example right now where March 21st or whatever. So AMC, if you look at that on Friday, which would have been March 18th, 2021. If you look at that on Friday, it was like super manipulated. Like I've never seen anything like that. I don't know if you looked at the chart, but it was at like 1430 and 1440. It literally just went straight sideways in that range all day long. And then at 1602, like four o'clock in 2 seconds, there was 45 million shares executed 2 seconds after the bell. So you know that there's just like a huge hedge fund in there that's trading that thing, and then it dumped it down 50 cents. So, you know, everybody on Twitter is all like freaking out about it because they're saying like, well, it's kind of manipulation. And like, I just happened to look at it because I haven't been watching it for a while, and I just glanced at it and I was like, I looked at it, I was like, wow, I haven't seen anything like that since like OTCs years ago, right? That used to happen all the time. Guys they'd just channel it into a little range, and then they would fill whatever side they're working on, whether it's the long or the short side. They would put a huge short order and a huge buy order, and then they would just get filled in whatever side they want it to be. And then they would lift the opposite side of the order and the stock would just rip down or up, right? So I don't know what's going to happen on Monday, but it should be interesting. I think it's probably going to rip down based on the fact that it dipped a bit after hours.
And you said it was Friday, right?
Yeah.
So that makes sense because Friday's expiration Friday, that would be calls and puts or options were expiring that day.
Okay.
So I think these guys were not only playing the market, but they're also playing the market and then probably screwing up some options buyers. I don't know if the long side or the short side, but they're probably fucking them over somehow too.
Yeah. It was just really, I've honestly never seen that in 4 years of looking at markets. I've never seen that on a listed stock before. It's really weird.
It's this kind of thing that worries me because I think we both keep saying it. We've never seen markets behave right now the way that it's behaving.
Yeah. Yeah.
So that's why like my strategy of being in cash, I'm like thinking like it would be the dumbest thing to do in like periods of calm, just like straight up movement, like good times. But I don't think we're heading into like calm times.
No.
So like that's what I'm thinking. Like if we're not heading into calm times, then the strategy should be in cash and not be constantly getting exposed by inequities, right?
Well, it's like, remember that article I sent you this morning? I think it was on Seeking Alpha. It said that, like, I can't remember the numbers. It was something like there was, out of the 300 some odd billion stimulus checks, there's like $57 billion of it that is going into equities and Bitcoin, like at a 50-50 split. I was just like, oh man, these people, and so I'm looking on Twitter and it's like, there's people on there like, yeah, man, like, my stim check just came in going right into the stock. And it's like some guy, like, he bought like $400 worth of GME or like something stupid. I'm just like, oh my God, man. But like, that's the market we're in right now, right? The government's just handing money out to people. There's millions of new traders in the market that have no idea what they're doing. And it's just making things like totally out of whack. Like moves are just getting so much more dramatic. It's crazy.
Yeah, and like I'm genuinely scared for the crypto market. Not so much for Bitcoin, because there seems to be like a giant group of people that don't even care about Bitcoin. They go straight into crypto and they start buying all the shit coins, like the things that do nothing, because they rip like 10x, 100x, like a GME. Yeah. And so like there's this one coin that's like, it's making me really mad because it's absolute garbage, but it did like 100x in like 3 months. Okay. It's like $8.50 now, but it came up from like 3 cents.
Oh, yeah.
And so like it's called Theta. So basically, these guys are trying to create a decentralized YouTube, which makes no sense to me. Because it's like, why would YouTube? There's some certain things that should not be decentralized, right? When you have a central server, you get efficiencies, you get good download speeds, you get good efficient hard drive use, right? If you start to decentralize content, then like every node becomes a server. Then every node has to hold the same content, right? It's like BitTorrent. When you go on BitTorrent, only the popular movies download fast, and the less popular ones download slow because not many people hold them. That's the problem with decentralization, right? But these guys are trying to just play on the blockchain thing. They're like, okay, let's decentralize YouTube because fuck it, why not? And then we're going to make it so that we're going to create this token, and it's going to pay the content creators, and it's even going to pay people to watch it, right? And so people are piling in on this. They're like, oh, what a great concept. If I'm watching this YouTube thing, YouTube competitor, I get paid. And then if I'm a content creator, I get paid too. I go on their website. Their most popular video has 350 views.
Yeah, but that's the thing, though. It's not about what it is, right? Like, I mean, like for me, this is no surprise for me because that's the world I live in, right? Like every single stock that I trade is a useless company that's not making money, that's probably horribly in debt, has 16 pages of offerings over the past years. And, you know, every single day on my scans, I'm seeing stuff that's up 30, 40, 50, 60% every day, right? So it has nothing to do with the company. It's just people are seeing this stuff. That's why I like that stuff, because the people that are buying that kind of company, I know they don't know what they're doing. So it's easy to take their money. So
Yeah.
you know, they see something that's garbage, and they're like, oh, like, man, this thing is 3 cents, or you know, it's 5 cents, or it's 6, whatever it is, and they're like, wow, like this sounds like a good idea. Like, man, I could take $1,000, throw it into this thing that's 3 cents, and if it goes up to 6 cents, I just doubled my money. If it goes up to $1, then I can quit my job, right? That's all they're thinking. But like, you know, there's thousands and thousands of stocks out there that are all in the same area. So the odds of you actually getting into the one that's going to do that and make you that money is so, it's like winning the lottery. Like, it's so infinitesimal. It's like, it's just gambling. That's all it is. It's just gambling.
It is gambling, but the thing is, a lot of these guys actually think, they look at tokens as if they were equity. They even talk about it like, I'm investing in this coin. I'm like, you're investing in nothing. They sold you a piece of digital code. Like, you own that.
Yeah.
And it's like, and that's why, like, I'm really afraid for the crypto market, because I think what happened in the 01.com bubble is going to happen in the crypto market. Because 01, internet was the hottest thing. People were investing in pets.com, even though it did nothing. Right? Like flowers.com, right? These companies did nothing. And so they all crashed because they do nothing. So like, I'm worried that a lot of these stimulus checks are going to go into like fucking Theta, this decentralized YouTube who has no marketing and no views. And they crash, and they're going to lose all the stimulus checks.
Yeah, for sure they will. But but then on the same token, you know, if you look at, like, it'll be interesting to see how Bitcoin handles that, because if you look at something like Bitcoin, where there is, you know, you have banks, you have fund managers, you have all these like real investors putting their money into that, they're going to be looking at that as, you know, buying something cheaper on the dollar. If it comes down a little bit, they're going to be dip buying that. Whereas all the garbage that's, you know, the thousands of cryptocurrencies that are garbage, nobody's going to be buying them. They're just going to come straight down, and all those people are going to lose their money if they don't sell when they're on their way up, right? But if you look at Bitcoin or some of the better ones, we know that there's institutional investors. We know that there's companies buying this. We know that it's getting widely accepted. It's something that if it comes back a little bit, people are going to buy it as an investment because they know it's becoming worldwide viable. That's the difference.
Yeah, 100%. It's funny you should say that. I just made a bet with a guy last night. I was a little drunk, but it's still a good bet. So there's a guy named Willie Wu. He's a really good analyst for Bitcoin. He does a lot of the on-chain analytics, and he looks at the data and whatever. And he made a post last night that said, basically, he said Bitcoin will not. There's so much support for Bitcoin at a certain price that it shouldn't ever trade below $1 trillion asset class anymore. So $1 trillion is probably like 55K Bitcoin. And I'm like, I bet you it will. And a bunch of people said, like, I bet you it will, right? And then he actually bet another guy. He said, okay, I will take a bet that Bitcoin will not close below $44,600 anytime this year on the daily.
Okay.
And I'm like, I'll take that bet. I bet him half a Bitcoin. And he accepted. So he's in Australia, I think. Like, I think he's asleep, but I'm waiting for him to wake up. We're going to put this thing in escrow and see what happens, right?
Yeah.
Like, on the surface, it seems like a stupid bet, but if you think about it, I basically bought a put option on Bitcoin, right? Where I'm going to get half a Bitcoin if I'm right, and I'm paying no premium. Because that's the problem with options. Like, you generally lose money because of the premium. It's just overpriced, right? But if I'm getting the option for free, if Bitcoin goes up, my entire portfolio goes up. Okay, so I just lost a little insurance money. Big deal.
Yeah.
Bitcoin goes down, I get half a Bitcoin.
Yeah. That's a good bet.
Yeah, it's a good. Like,
you're hedging yourself.
What's that?
You're hedging yourself.
I'm hedging myself, and I did it while drunk too, so I'm pretty proud of that.
Are you sure this actually happened, right?
Well, yeah, I screenshot it. Like, I was watching Yellowstone last night. I was drinking, and I was checking my Twitter. I'm like, wait a minute. I'm like, I just take that bet. I fell asleep. I woke up this morning. He's like, I accept. I'm like, oh.
Guess I got to do this now.
I guess I got to do this now. So yeah, let's see what happens. But yeah, man, it's like, I think that's the important thing, right? It's like, it's a matter of perspective. You can't look at anything from a linear perspective. Yes, it'll go up. It can only go up, or it can only go down. Like, but within that, you could like structure things that'll help you out, right? I'm
Yeah.
not a Bitcoin bear, but I know it should go down. And
Yeah.
44,600 is a very reasonable level,
Mm-hmm.
right?
Yeah, I don't see the crypto market crashing like it did either in 2017, because the fundamentals and like the people that are involved in it now is so different from back then, and it's really not like, it's not like a hype thing like it was then. Like if you think of the dot-com bubble, or you think of like any of the trendy things, like we had the Ebola stocks, like the coronavirus stocks, like all, like all those different sectors, like the weed stocks, like when any of that stuff kind of starts to run, like it becomes all everybody's talking about, and it's such a big focus that that's kind of one of the advantages of being in small cap land, is I see that every day. So like I'm seeing this random company that has nothing to do with Bitcoin being like, oh yeah, like, oh, and by the way, like we just bought a blockchain, like something that doesn't even make sense, right? And then their stock goes up 200%, right? Like we're not seeing that now. Like I'm not seeing any of that in the small cap world. Like people are announcing stuff about Bitcoin, it's you're getting a modest move. It's not like people aren't going crazy about it anymore. So from that perspective alone, I would say that I wouldn't consider it a bubble right now by any means. But yeah, like the coronavirus stocks, all that stuff, that was a bubble. I mean, things ripped up. People would say, oh, we're thinking about making lab coats that are good around coronavirus. And the stock goes up 300% overnight, right? Like that's the kind of stuff that is a bubble.
I saw this one company. They made these electronic sensor GPS things, and as soon as coronavirus happened, they pivoted. They're like, corporations will start using this. Every employee in an office will start wearing these trackers, and they'll tell you when you're getting too close to somebody.
Yeah, great.
It's like what? Like, what?
Yeah, I know. That's how it works, right? Because like you can release anything in a news article. Like there's nothing illegal about saying something in a news article. Like if I owned a company, I could be like, my projections for our company next year, that we're going to be, we're going to quadruple our earnings, we're going to quadruple our sales. Our company is going to go from being worth nothing to being worth $10 million by next year. I can release that in a big headline, send it to all the news articles, like maybe that's my plan. Maybe that's what I'm trying to do. There's nothing wrong with that, right? So people see that, and then if it's something they're excited about, they'll go nuts about it, right? That's why they do that, is they as a company can say, okay, like we manufacture pens. Let's just say, oh, we're manufacturing, we're starting to manufacture pens for hospitals to help with coronavirus. They've probably been doing that for 30 years. It's pens. Everybody uses pens. Like it goes to the hospital, big deal. Stock goes up 200%, right? Because they see coronavirus, and then it goes up.
Use this new antibacterial coating on the pens or something.
Yeah, anything, right? Like it could be just a thought that they had, and they're like, okay, well, we're thinking about it, so let's make a news article, make some money, right? That's all.
Meanwhile, the CEO, the C-suite executives out back are dumping the stock.
Yeah, exactly. Well, that's what they do. That's the first thing I always do, is I look and I'm like, oh, look at that. They got a $200 million at the market offering, and they just sent out this bogus news article. Like, I wonder what's going to happen.
Yeah, you remember? I don't know if you remember, like a few months ago when the Moderna first released their vaccine results. Like it was preliminary. No one's even like, what's it called? Nobody's vetted the study or whatever. But they announced the test results, and they found out like a week later that the CEO was selling shares.
Yeah, for sure. Yeah, because he knows he's going to get a huge move, right? So he might as well take advantage of it.
There's so much manipulation in the market, man.
But like that's the thing, right? Like that's what happens all the time. Like there's those sectors, and then there's like the big monster bubbles, right? So like you get sectors like that all the time where stuff just runs up like crazy. But that's going back to Bitcoin again. That's why I don't think it's going to be something that pulls it down hard. I think it's just going to be all the garbage companies that all the garbage cryptocurrencies or whatever that are going to come down, just because they're garbage and nobody's going to actually invest in them. But like I said, I mean, in small caps, like you're not seeing the same kind of push that we did back in 2017. And that's when everything came down hard, because everybody who couldn't afford to invest in Bitcoin, they're investing in these really shit companies and they're losing all their money, right? Now we have, all these institutional investors, we have ETFs, we have, all these different things that are legitimate areas that people can put their money into the stock or into the crypto without actually buying Bitcoin. So it just becomes a lot more viable. It's a lot harder for it to just snap and fall, because the people that are putting their money into Bitcoin itself in some regard is not garbage news articles. It's actual real cryptocurrencies to some degree.
Yeah, no, that's a really good point. That the first Bitcoin ETF that got approved in Canada, the Purpose ETF, they started out with I think $5 million worth of Bitcoin, which is nothing. That was like day one of trading. as of Friday of last week, they now have $1 billion asset under management, about 14,000 Bitcoins they now own. I mean,
Right.
so within like I don't know, it's been a 5-week period, these guys have snapped up 14,000 Bitcoins, just snapped it up off the market. Like,
and that's our Canadian one. So once they open one of those in the States, they're going to do the same thing, and it's just going to be all that buying pressure, right?
Yeah. So actually, it's funny you mentioned that. The next 45 days should be interesting because there's 5 ETFs that applied for, or maybe 3 that applied for approval in the States.
Right.
The first one that did, Van Eyck, they've applied before it got rejected. They applied in December, and now the SEC has announced that they're actually looking at their submission now, and the SEC has 45 days to respond yes or no. So if you think a Canadian ETF can do $1 billion, what can a US ETF do?
Oh yeah, it'll be 10 times for sure.
Yeah, so they might be snapping up. I mean, if they get approved, they're going to be snapping up the Bitcoin.
Yeah, that'll be really good.
Yeah, so it's an interesting time right now, but that's why like I want to have cash on the side because like you've seen the charts, right? The stocks look overextended, like almost every stock, like the big guys, the big caps, even the indexes, right?
Yeah.
And I just don't see. I'd be happy if they made new all-time highs, but I don't see it happening.
Yeah, it's tough. I don't like it. I don't like it when anything just goes steadily up for a really long time. I like to see like those nice waves. It's kind of settled a little bit and come back up. When things just get more and more nervous the longer things just kind of keep creeping up and creeping up and creeping up. Like
yeah. And it's like I'm wondering, like, what happens when stimulus dries up? Like, there's no new money.
That's a huge thing that a lot of people don't realize. And when that happens too, like, so many of these people are putting their money in the junk stocks, like we already know. So a lot of them have already lost their money. They're probably going to lose it again. And then there's going to be no more stimulus. And then there's still going to be all those people that are unemployed. It's going to be, it'll be interesting to see what happens. So.
Yeah. So, yeah, I'm going to give it more thought, but I think right now I'm going to do maybe like 40% in cash, do my same strategy. I'm going to hold my same core Tesla position, but maybe start trimming some of it, like hold less than I normally would have. And then, just like 40% in cash and just wait.
Yeah, I'm about the same right now. I think I'm like 20% cash right now.
Yeah.
I I'm using a little bit more to do like the swings and stuff I'm working on. But even so, like, I mean, I think like 40% I'm in like longer term stuff. And then everything else, I'm just in like swings that I'm looking at for like a week or a month period. So it's not like I'm going to be tied up very long anyways.
Yeah. So I think that's going to be. Oh, by the way, I remember we were talking before, like just kind of jokingly, if we should open a fund or whatever.
Yeah.
So I asked my buddy about that. He says it's actually super difficult from a regulatory perspective. Like their family has a fund, but they opened it decades ago at a time when the regulation was a lot easier.
Okay.
So it's like now, if we wanted to do what we wanted to do, a fund is probably not possible. But what we would do is we would create a corporation and pool our money into the corporation and invest it as the corporation.
Oh, okay. So you just make like a business basically.
Yeah, we just like you register a corporation. It'll be like a business that where the cash flow will be used for investing purposes, and we just pay capital tax gains or whatever it is.
Yeah. So basically the same thing, anyways.
The same thing, yeah. But
Jack of all trades fund.
Yeah. Yeah, exactly.
Investing us.
Oh man, imagine we go public. Let's go public with via SPAC.
Oh my god. We'll be billionaires. I can retire. Everybody's buying those things.
Oh, let's do a Wolf of Wall Street. Like sell it on the pink sheets, like OTC.
Yeah, exactly. Probably good, man. There's a lot of people that buy that now.
Oh my god, that's hilarious. Let's set that up. Let's set that up for like 8 years from now. The next boom, the next big stimulus.
Yeah, the next big crash when the government starts giving out money. That's when we'll open our fund. And we'll be open for 6 months, and we'll shut it down and move to the Bahamas.
Yeah, exactly. All right, that's awesome. I think we should end it from here. What do you think?
All right, sounds good.
Awesome. All right, thanks guys for watching. Like and subscribe, and see you next week.
That's it.